Can you explain the difference between a credit spread and a debit spread?
Absolutely. A debit spread you have to pay, right? That's why it's a debit. So basically a straight call and a straight put. Now, if you do something like a vertical debit spread, that means that you have something called your anchor leg. So your anchor leg is always going to be your main money leg, the leg that you care about, so to speak. That's going to be the leg that you're bullish on, let's say, if you buy a call option. But sometimes what you want to do, if volatility is, let's say, somewhat high, maybe not extremely high, but somewhat high, you might want to sell a call against that security. And we talk about that in our class too, how to do that. So that actually lowers the cost of your trade, because you have a debit trade, which is your expensive anchor leg, which is the main trade you're trying to do. You're bullish. But then what you're doing is you're essentially selling something against it. And what that does is it lowers your cost, but it actually caps your gains. So that's the trade-off that you have, okay? Now, there are ways to eliminate capping your gains at certain times, which is helpful as well. But either way, without complicating things too much, net, when you have that two-leg strategy, you're still paying a debit. If you add those two together, you're still paying. So that's a debit strategy. So in a debit strategy, time is against you, right? If you net the two out, time is still your enemy. And you want to take advantage of movement in stock and volatility. A credit spread is the opposite, in the sense that your main leg is your net seller of an option. So now when you're a seller of an option, you have an obligation. You don't have a right to do something. You have an obligation to either receive shares or deliver shares out. Now, in order to lower that risk, what you can do then is buy an out-of-the-money debit trade. So that, again, if you add those two together, now you're a net credit trader. So the difference between a debit trade and a credit trade is what you're paying. A debit trade you are paying, and a credit trade you are receiving. And you're just basically running out the clock. When you're a credit trader, you have time working on your side as opposed to working against you. And ideally, in a perfect world, you want to be a credit trader in a high volatility environment, and you want the volatility to decrease as the time is melting away. And that allows you to profit from a decrease in volatility, and it allows you to profit from the passage of time. And that's the difference between debit and credit, essentially. Most people are one or the other. They have a bias, which is also a very bad thing to do. I'm actually coaching some traders in our classes now, and they're credit biased. They love the idea of being able to just sit and collect a premium, kind of like an insurance company collects a premium when you have a car insurance. They just sit back and collect a paycheck as long as you don't get into a car accident. Same concept. That's why they use the word premium. So basically, I'm trying to get them out of the habit of just always doing one thing, because when volatility is low, it doesn't make sense to do any of those trades, and you're not getting paid to take on that extra risk. You really got to use both tools, both sides, either debit or credit. So strategy selection with options is extremely important.